The week of Monday, March 24th, 2014 through Friday, March 28th, 2014 had a flattening of the yield curve as well as a negative shifting of forecasted rates. Also, there was a rebound or steepening of the yield curve and positive shifting of the forecasted rates. These were caused by external geopolitical forces, specifically the Russian troop deployment to the Ukraine, and internal measures by both the Federal Reserve Bank and the Bureau of Labor Statistics. The measures and forces affecting interest rates will be discussed further in the presentation. Interest rate forecast: how the Treasury yield curve flattened and bounced back. The week of Monday, March 24th through Friday, March 28th had a general flattening of the yield curve from Monday to Friday, with two separate actions generally. The first action was from Monday to Thursday. The yield curve flattened pretty drastically because of both geopolitical and financial news throughout both the U.S. and the world. From Friday on Friday, the yield curve rebounded with a steepening for the most part. The steepening of the yield curve did not bring it back to where it was on Monday, yet the 7 year notes specifically increased greater than it was on Monday, showing the only increase day to day during this week. From Monday, March 24th to Friday, March 28th, the data retrieved showed two specific moves in the yield curve, which generally flatten the yield curve, but the two moves were Monday to Thursday, the big flattening, and then Friday had a general steepening of the curve, which almost had the yield curve rebound to its Monday figures. Between Monday and Thursday, the 10-2 and the 2-5 spreads both decreased, with differences of 1.9 basis points and 1.8 basis points respectively. But then on Friday, the same two spreads increased by 2.9 basis points and 2.2 basis points respectively. The 530 spread was unchanged from Monday to Thursday, but on Friday there was a slight steepening. Also on Friday there was an anomaly of in the 7 year note yield. I would hypothesize that the reason why the yield curve steepened specifically for the 7 year note is that investors wanted to get into the treasury market but didn't want to go long term and didn't want the volatility of long term, but wanted to have their money invested longer than the 3 month or the 1 year security. The 7 year security yield to maturity is marked on the yield curve by the red arrow pointing at the red graph line. Now, the changes in the yield curve were the effects were seen because of 5 different instances. All right, the first incident was the Russian recession that's projected because of the troop movements by Vladimir Putin, and that happened throughout the entire week. Also, there were statements made by Fed President James Bullard of the St. Louis branch that he spoke about the ambiguity of the quantitative easing program, how the Federal Open Market Committee will review the current numbers and will not use the 6 month benchmark to determine when they're going to stop quantitative easing. But he also stated that the U.S. growth rate, he expects it to be more than 3% in 2014, and then the unemployment rate to be below 6% by the end of the year. Now, on Thursday, Janet Yellen somewhat redacted James Bullard's statements by saying that the central bank may end the quantitative easing this fall. She called it bond buying. And once they quit the bond buying, they're going to increase borrowing costs or the interest rates 6 months later. Um, Thursday's 530 spread was 1.798% from the data retrieved from Wall Street Journal. And Walker, a Walker on Bloomberg, stated that uh, she showed that the 530 was 1.8 percentage points, which was the least since October 2009. Also, as I stated before, on Thursday, Putin increased the troop deployment and also started setting supply lines, which seems for both the U.S. and European allies that he's looking at long term deployment and possible takeover of the Ukraine. On Friday, the rally was caused by three separate things. GDP came in just below expected, but it was greater than what they thought after research was conducted. Also, jobless claims decreased by 10,000 in the period ending March 22nd. And also within that jobless claims study, the 4-week average of state agency applications for for unemployment dropped to the lowest level since September of 2013, and that's also from Suzanne Walker's article. This is the ask yields that were retrieved from the Wall Street Journal for Monday, Thursday, and Friday, as well as the change in ask yields from Monday to Friday. As you can see here, for 7-year treasuries, there was a general increase in only 1 month, and that was for year 7. The forecasted rates came directly from a formula which we learned about in Finance 401. It was actually set up by Professor Lewis, but it takes into account the yield curve as well as the expectations hypothesis and the liquidity risk, as well as other things. The forecast rates generally followed the yield curve. The same anomaly showed up in both, specifically the 7-year and the year 7 for the 1-year rate. Now, because the rates were not very volatile, in the yield curve they weren't very volatile. There wasn't a lot of movement in the forecasted rates. The forecasted rates generally stayed the same, but you can see the differences specifically in the year 7 1 year and then year 8 1 year. The year 8 is drastically lower than the Monday and Thursday. On Friday, specifically because of the adjustments that were made from the year 7 to the year 8. The forecasted rates graph for the week of Monday through Friday, March 24th through March 28th, didn't move very much, simply because there wasn't a lot of movement in the yield curve. The general movement was a shift downward because of depressing news as far as the economy goes. The one day where we had good news, Friday, the forecasted rates generally shifted up in some areas. The 7-year note specifically stayed flat, as the rest of the week the 7-year notes decreased severely on the forecasted rates graph, and that's because of the increase in the ask yield for the 7-year treasuries. The reason why it's flat and not a true increase was because there's really not a lot of volume in 7-year treasuries. If these were 10-year treasuries we were talking about, I would expect to see a larger increase. The graph shown here is for the forecasted rates for year for 1 year treasuries, 1 year out, 2 years out, I'm sorry, 2 years out, 3 years out, 4 years out, and so on to year 30. The largest increase that I found was the seventh year of the 1 year treasury, where it was half a percentage point. That was by far the largest increase. Uh, there were several years showing a decrease in percentages. That was caused by the general flattening of the yield curve.